A 67-year-old retired man walked into the same bank he had used for more than 20 years. He asked for $22,000 of his own money. He walked out with his entire account frozen. For 19 days, he could not access a single dollar. There was no fraud, no criminal case, no investigation. He had done nothing wrong, and the bank was still fully allowed to do it. If you are 65 or older, this can happen to you right now, and almost nobody is warning you. Stay with me, because there is one phone call that can stop this before it starts. Hi, I'm Lana Maines. If you're new to the channel, subscribe and turn on notifications right now. Every week I cover the financial rules that hit seniors directly, the protections you may already qualify for, the changes that matter, and the steps that actually make a difference. That is what this channel is about every single week, and you do not want to miss it. Now let's get into it. There is a rule your bank will never sit down and explain. Take Gerald. He is 67 years old, a retired middle school principal from Dayton, Ohio. He had kept the same checking account at the same regional bank since 1999. He had a pension, a paid-off home, and about $41,000 in that account. Then one ordinary Tuesday morning, he went into the bank and asked to withdraw $22,000 to help his son avoid foreclosure. That is when the compliance flag appeared. Then the manager appeared. Gerald was taken into a private office and questioned. They asked who the money was for. They asked whether anyone had recently called him and told him to move funds. They asked whether he had met anyone new online. Think about that. A 67-year-old retired educator with a spotless financial record was being treated as if he may have been manipulated into helping his own son. 2 days later, the bank placed a hold on the withdrawal pending review. That review lasted 19 days. Gerald had done nothing wrong. Here is the legal framework that made it possible. More than half of all U.S. states have passed laws allowing financial institutions to place temporary holds on accounts owned by customers who are 65 or older. The stated purpose was elder fraud prevention. But the real-world result is this. A bank can legally hold your money for 14 to 15 business days. Once you add weekends and holidays, that becomes roughly 21 days. The bank does not need proof of fraud. It does not need a court order. It does not need your permission. It needs a compliance trigger and your age. And that trigger does not have to be criminal. It does not even have to be suspicious in the ordinary sense. It only has to match one of the patterns the bank's software is programmed to flag. And to understand why this changed, you need to know what shifted legally. For most of banking history, if a bank delayed a customer's own transaction without proper cause, that bank could be sued. Banks had very little legal protection if they interfered, even when they suspected something was wrong. Then, elder financial exploitation losses climbed into the billions every year. Lawmakers responded by giving banks safe harbor protection. That means a bank cannot be held liable for delaying or freezing a transaction if it reasonably believed an older customer might be the victim of exploitation. That one legal shift changed everything. It turned a teller's instinct into a 19-day hold with no penalty for the bank. And the language in these laws explains why so many people never see this coming. Most of these statutes use the phrase specified adult. In almost every case, that means anyone 65 or older. In some cases, it also includes younger adults the bank believes may be vulnerable for other reasons. The day you hit that birthday, you are quietly reclassified inside the bank's compliance system. Nothing about your judgment changed. Nothing about your behavior changed. Nothing about your account changed. But the bank's software changed how it sees you. And nobody sends you a letter to tell you that. You usually find out only when a transaction that would have cleared instantly the week before suddenly does not. And that brings us to the 6 triggers, because any one of them can activate a hold on your account today. Trigger 1 is an unusual withdrawal amount compared with your account history. If you normally withdraw around $800 a month and then walk in asking for $15,000, the software flags the deviation no matter what your reason is. So what do? Call the bank at least 48 hours in advance for any withdrawal that falls outside your normal pattern. State the amount. Give the purpose in one sentence. Ask the branch to note it in your account record before you arrive. That one call can turn a flag into an expected transaction. Trigger 2 is a payment to a new or unfamiliar third party. That could be a wire transfer. a cashier's check to a title company in another state, a Zelle payment to a new contact above a certain amount. Before you initiate any new payment over $5,000, confirm it with the bank by phone or in writing. And keep documents explaining the transaction, a bill of sale, a closing disclosure, a letter from an attorney. One document can change that transaction from unknown to explained. Trigger 3 is a report from a bank employee who believes a customer may be cognitively vulnerable. A teller who sees confusion, unusual behavior, or a third party coaching the customer can file an internal report. That report can trigger a hold, even if there is no dollar threshold at all. So what do? Do not bring a family member into the transaction area unless that person is a named account holder. If someone drives you to the bank, let them wait outside. Your composure matters. Your independence matters. Both become part of the record. Pause here for a second. Look at your bank account right now and review your last 6 transactions. Ask yourself whether any amount would stand out as a break from the pattern of the previous 6 months. If you can see the break, the bank's software already can too. Trigger 4 is a transaction that crosses the $10,000 federal reporting threshold under the Bank Secrecy Act, under Title 31, United States Code, Section 5318. Any cash transaction above $10,000 requires the bank to file a currency transaction report with the Financial Crimes Enforcement Network. That report includes your name, social security number, address, amount, and the exact time of the transaction. You will never receive a copy, and the bank is legally prohibited from telling you they filed it. In states with elder hold laws, that report alone can trigger a hold review when the customer is 65 or older. So what should you do if you are depositing or withdrawing a large amount of legal cash? Bring documentation explaining the source before you ever reach the teller window. Walk in with the paper trail already in your hand. And there is one warning here that matters more than almost anything else. Do not try to get around the $10,000 threshold by splitting the withdrawal into smaller amounts. That is called structuring. And breaking up transactions specifically to avoid the federal report is its own separate offense. It does not matter if the money is completely legal. It does not matter if it is entirely yours. The safest move is always one clean transaction with documentation, never a series of smaller ones designed to avoid the report. I have seen that one misunderstanding cause more damage than the original large withdrawal ever would have, because a structuring flag does not clear in 19 days. It can trigger a much longer federal review simply because the senior was trying to be careful and made the situation worse. Trigger 5 is a beneficiary update or a change of address request filed close in time to a large transaction. The software cross-checks timing. A new beneficiary on Monday and a $20,000 withdrawal request on Friday can look like a pattern, even if those two actions are completely unrelated. So what do? Separate those actions by at least 30 days whenever possible. If the timing cannot be separated, call the bank in advance and have both actions noted in your account file, so they appear deliberate instead of sequential and suspicious. Trigger 6 is a family member or caregiver contacting the bank separately and expressing concern. An adult child may mean well. But if they call and say they are worried about a parent's financial decisions, they may have just activated the compliance framework even without accusing anyone of specific wrongdoing. The bank does not need to investigate at that point. It only needs to log the concern. And I'm going to show you exactly how to neutralize that trigger in the next section, because this one requires a structural fix, not just a conversation. Those are the 6 triggers. But even if you know all 6, you are still reacting after the fact. And here is the part that should make you stop cold. Your bank is not penalized for freezing your account incorrectly. No fine, no regulatory punishment, no legal consequence for holding your money for 19 days on a trigger that turns out to be nothing. The pressure goes the other way. If a bank fails to act when a trigger is present, that bank can face regulatory sanctions, civil liability, and federal investigation under elder financial exploitation laws active in more than 30 states. So the incentive is obvious. Freeze first, investigate later. Apologize if at all. That is the system. The bank is not acting as your partner in that moment. It is acting as a compliance organism designed to protect itself from liability. Your 19 frozen days are not some rare malfunction. They are the predictable result of a system working exactly as designed. And inside that system, the only person with a structural reason to stop the freeze is you. That is why the next step matters so much. There is one phone call that can completely change your position. It costs nothing. It takes less than 15 minutes. There is no fee, no product, no account minimum. And it creates a legal paper trail that applies to every transaction in your account, regardless of size. The call is to your bank's Elder Services Department, its account protection line, or if it has neither, the branch manager directly. And in that one call, you need to request two things. First, ask for a trusted contact person designation to be placed on your account. Under Financial Industry Regulatory Authority Rule 4512, in effect since 2018, financial institutions are required to allow customers to designate a trusted contact. This is not a power of attorney. It does not authorize anyone to access your money. It simply names a person the bank can contact before starting a hold. Someone who can confirm that you are acting voluntarily and understand what you are doing. That designation changes the bank's first step. They must contact your trusted contact before placing a hold, not after. Second, ask for a standing transaction authorization letter to be placed in your file. That is a written statement describing your normal transaction patterns and directing the bank to treat activity within those parameters as pre-approved. It does not eliminate compliance reviews for truly unusual activity. What it does eliminate is the automatic flag for conduct that is normal for you but appears unusual to software with no context. That one call, a trusted contact designation plus a standing authorization letter, directly addresses 5 of the 6 triggers. And the 6th trigger, the concerned family member, is addressed by the designation itself. If your trusted contact is already on file and confirms your clarity and intent, the bank has a documented response to any outside concern raised against you. But there is a catch. This protection is not retroactive. It applies only from the moment it is filed. If a freeze starts before the designation is in place, filing it later does not reverse the hold. This call works only if you make it before the trigger fires. So here is what I want you to do. The exemptions, tax breaks, refunds, and savings most seniors already qualify for but never claim, I put all of them in one place, state by state and form by form, so you do not waste hours digging through government websites. It is laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you are in, there is likely money you are still leaving on the table. It is called the Senior Exemption Playbook. It is in the first pinned comment right below this video. Tap it once, and you will have everything you need. Now stay right here, because the final protection I'm about to give you is the biggest one most seniors never put in place, and it is the reason I made this entire video. There are 2 backup layers that close the remaining doors. The first is a durable financial power of attorney filed directly with the bank, not just notarized and stored at home, not left sitting in your attorney's office, filed with the bank, acknowledged in writing, attached to your account record. Under most state statutes, a durable power of attorney already on file creates a second mandatory checkpoint before a hold can be extended beyond the initial review window. Without it, the bank's compliance team operates with no outside accountability. With it, there is a named individual with legal standing to intervene on your behalf. And the word durable matters here. A standard power of attorney can become invalid the moment you are deemed incapacitated. That is exactly when you would need it most. A durable power of attorney is drafted to remain effective through incapacity. So if your current document does not specifically use durability language recognized in your state, the bank may treat it as invalid at the exact moment your family is trying to use it to free your funds. The second backup layer is a written baseline transaction record submitted to your bank every year. 1 page. Your name, your account number, a short description of your normal financial activity, your monthly withdrawal range, your recurring payees, your typical transaction frequency, signed, dated, filed with the branch manager. That document gives the bank the context that can turn a flag into a non-event, And you also need to know this: not every bank handles these protections the same way. Some institutions offer trusted contact designations only on brokerage or investment accounts, not on standard checking accounts. If your branch says it is not available, ask for that in writing. And if they still say no, that may be worth escalating to your state's banking regulator, because FINRA Rule 4512 applies broadly across most regulated financial institutions. Gerald had none of these three protections in place: no trusted contact designation, no durable power of attorney on file with the bank, no baseline transaction record. He had a 24-year banking relationship, a spotless history, and no protection on the day the compliance system decided his withdrawal looked unusual. He got his money back on day 19. You do not have to wait 19 days. Here's what you do now. Step 1. Call your bank today. Ask for the Elder Services Department or the Account Protection Line. If the representative does not know what a trusted contact person designation is, ask for the branch manager. Use the phrase FINRA Rule 4512. It is a federally recognized requirement. Step 2. Name your trusted contact before you hang up. That can be an adult child, a sibling, a trusted friend, or your attorney. This is the person the bank calls before placing a hold. Get written confirmation that the designation was recorded. Step 3. Request the Standing Transaction Authorization Letter form. Describe your normal monthly activity honestly. Sign it, date it, keep a copy. Step 4. Bring your durable financial power of attorney to the branch in person. Do not mail it, hand it to the manager. Watch it get logged. Ask for written confirmation that it is attached to your account record. Step 5. Set a calendar reminder to review and resubmit your baseline transaction record every January. A record from 4 years ago will not protect a transaction pattern that looks different today. Step 6. Tell one person you trust that you made this call. Not because you need their permission, but because the strongest protection against the family member trigger is a family that already knows your financial decisions are deliberate, documented, and on file. Your money is yours. One phone call made today can help make sure the bank is legally required to remember that before it touches a single dollar.